options trading strategies video, we're going to talk about the bearish strategy of selling call options. So let's get right into the basic strategy characteristics of a short call position. Alright, so short call strategy characteristics. First of all, selling call options is also sometimes referred to as being short calls, and this is a bearish strategy that consists of selling a call option on a stock that a trader believes will decrease in price or at least not increase by too much. Now, the maximum profit potential for a short call position is the credit you receive for selling the call times 100. Now, the maximum loss potential is unlimited because there's no limit to how high a stock can go, and with that, there's no limit to the price of the call that you sell. So if you sell a call for $1, it's possible, in theory, for that option price to increase to $100,000. Now, while that's not actually realistic, it is still possible, so something to keep in mind. Now, the expiration break-even price of a short call position is the call's strike price plus the credit you receive. So since you sell a call and you collect a premium for that, you actually have a little bit of a buffer for the stock price between now and expiration. So if you sell a call with a strike price of 100 and you collect a $5 premium, you actually don't need the stock price to be below 100, you just need it to be below 105 at expiration to make any money. Now, the resulting position after expiration is dependent upon whether or not the short call is in the money or out of the money. So if the short call is in the money at expiration and you hold the option through expiration, the resulting position will be negative 100 shares per call contract. So you'll effectively short 100 shares of stock per short call, and you'll be selling those shares at the strike price of the call that you sold. Now, in regards to assignment risk, if the short call is in the money before expiration, it's possible to get assigned negative 100 shares of stock per call contract, which again is a short stock position of 100 shares. So let's go through a short call example trade to really solidify what you just learned on that previous slide. So we're going to construct a short call position from this option chain. So we have various strike prices here, and we have the corresponding call option prices. So at the time of these prices, let's assume the stock price is trading for $100, and we want to initiate a bearish position, and to do that, we're going to sell a call option. Now, in this example, we're going to sell the call option with a strike price of 100, and we're going to collect a $10 premium for selling that call. So the stock price is at 100, we're selling the 100 call, and we're going to collect a $10 premium. Let's see what the expiration risk profile graph looks like for this short call position. Alright, so as we can see here, we're looking at the profit and loss of the short call position relative to various stock prices at expiration. So as you can see here, all of our profit is when the stock price decreases, and all of our loss potential is when the stock price increases significantly. So that black dotted line there is the short call strike price that we sold, and the green dashed line is the short call break-even price. Now, since we sold the 100 call for a $10 premium, our break-even price is $110. So the stock price can actually increase by as much as $10, and we can still not lose money on this trade at expiration. So where does that come from? Well, at expiration, options only carry intrinsic value, and at $110, a strike price or a call option with a strike price of 100 will be worth $10 at expiration. So since we sold it for $10 and at expiration it's worth $10, our profit is 0 and our loss is also 0. So at $110, we will break even on this position at expiration. Now, at any price below $110, we'll make money because that short call will be worth less than $10, or it will be worthless at expiration if the stock price is below the strike price of 100. So if the stock price drops to $70 at expiration, that 100 call is going to expire worthless because it has no intrinsic value, and since it expires worthless and we sold it for $10, we'll have a $10 profit on that position per contract. Now, since the actual contract multiplier is 100, that $10 profit in option terms actually translates to a $1,000 profit in dollar terms. So If the stock price is below $100, we're going to make $1,000 on this trade at expiration. Now, let's say the stock price goes to $150. Well, in that case, the strike price or the call option with a strike price of 100 will be worth $50 at expiration. Now, since we sold it for $10, we'll have a loss of $40 per contract, which translates to an actual loss of $4,000 per contract. So now that you know what a short call position looks like in terms of expiration, profits, and losses, let's go ahead and look at the short call Greek exposures to try and learn how a short call position makes or loses money before expiration. So let's start with delta. A short call position has negative delta, and that means that the position is expected to profit when the stock price decreases and lose money when the stock price increases. And that's because call prices rise when the stock price rises, which is harmful to short call traders. And when the stock price falls, call option prices fall as well, which is beneficial to short call traders. Now, a short call position actually has negative gamma as well. Now, that means that when the stock price increases, the position delta is going to get more and more negative, and as the stock price decreases, the position delta will get more and more towards zero. So what this means is that you do not want the stock price to increase because, number one, you have negative delta, so you're going to lose money when the stock price increases. But even more than that, as the stock price increases, you're going to get more and more short. So the further the stock price increases, the more money you're going to lose if the stock price continues to increase, which is called the negative gamma effect. So just keep that in mind. Now, a short call position also has positive theta, and that's because the extrinsic value of options decays over time, and that leads to decreasing option prices. So if you're short a call, you want the price to decrease, which means that if everything else is held equal and the only thing that happens is the passage of time, you're going to make money from the decay of the call's extrinsic value as time passes. So that positive theta is good for you. Now, lastly, a short call position has negative vega, and that just means that when option prices are increasing, you're going to lose money, and when option prices are decreasing, you're going to make money. Now, an increase or decrease in option prices is also referred to as a change in implied volatility. So that negative vega just tells you that after you sell a call, you want implied volatility to decrease because a decrease in implied volatility indicates that option prices are falling, which is good for you as a short call trader. Now, when we put all these Greeks together, we learn that a short call position makes money from a decrease in the stock price, the passage of time, or a decrease in implied volatility. So there's really a lot going for the short call strategy, and that helps explain why it has a higher probability of profit. So now that you know the theory behind the short call strategy, let's go ahead and look at some real example trades to show you how a short call position performs in various scenarios. So the first one we're going to look at is a short call versus an increasing stock price. So here's the setup. The initial stock price is $119.94. Initial implied volatility is 23%, and we're going to sell the 125 call with 71 days until expiration. Now we're going to collect a $1.52 premium for selling that call, which brings our break-even price to the short call strike price of 125 plus the 152 credit we received, which comes out to 126.52. Now the maximum profit potential we can make is the short call's credit of 152 times 100, which comes out to $152. Now the maximum loss is unlimited as there is no limit to how much the stock price can increase. So let's go ahead and take a look at how this short call position performs as the stock price is changing through time. Alright, so in the top of this graph, we're looking at the changes in the stock price relative to the short call's strike price and the short call's break-even price. And in the bottom part of the graph, we're looking at the initial price of the call, represented by the black dashed line, and we're looking at the actual changes in the call price via the blue line. So here we can see that the stock price starts right around $120 and actually is increasing steadily over this trade period. Now, since a short call position is negative delta, you would expect that an increase in the stock price would lead to losses for a short call position. However, a short call position is actually has positive theta, which means that as time is passing, the extrinsic value of that call is decreasing, which leads to profits for a short call trader. So the entire period, this short call is actually out of the money, which means that all of its value is extrinsic, which means that if the stock price doesn't rise to a level above the short call strike price, the short call will expire out of the money. So in fact, this is exactly what happened in this case, and the stock price did expire below $125. And as we can see there, right at the very right of the lower part of the graph, the call price expired worth $0. So in this case, the call did expire worthless, and as we can see here, it never really had any significant losses because the stock price was not surging through the short call strike price. So this example just really demonstrates that as long as the stock price is increasing at a slow rate, the positive theta can actually overwhelm the losses from that directional movement against you. So this just shows that even if the stock price is increasing, you can still make money from a short call position. Alright, in this next example, we're going to look at a short call position versus a stock price that gaps significantly higher. So in the previous example, we looked at a gradually increasing stock price versus a short call position. In this example, we're going to look at a significant increase in the stock price versus a short call position, and we're going to see the difference between the two. So here's the setup. The initial stock price is $52.58, and we're going to look at selling the 60 call that expires in 43 days. Now we're going to collect $2.28 for selling this call, which brings our break-even price to the short call strike price of $60 plus the $2.28 credit received, which comes out to $62.28. Now the maximum profit potential is the credit received of $2.28 times 100, which comes out to $228. And as always, the maximum loss potential is unlimited. So let's go ahead and see what happens to this short call position as the stock price gaps higher. Alright, so like before, in the top part of the graph, we're looking at the changes in the stock price relative to the short call strike price and break-even price. And in the bottom part of the graph, we're looking at the price of the short 160 call. So as we can see here, when the stock price was right around $50, we sold the 60 call, and over the next 30 days or so, the stock price remained well below the strike price of $60. And as we can see, the short call's price was decreasing steadily and was actually pretty much worthless with around 15 days to expiration. So in reality, this short call position probably would have been closed, because as the short call's price reaches a price closer to zero, you have less and less profit potential, but you still have unlimited loss potential. So when you can't really make anything more on a short premium trade, it's always a good idea to close it, because you still have all of the risk, but you have very little left to make. So in this example, in the first 30 days, the short call was pretty much worthless. But however, we can see that around 14 days to expiration, the stock price gapped up from $50 all the way to $90, so almost 100% increase. Now, as a result, the call with a strike price of 60 was worth right around $32.50 at the highest point, which is a significant loss considering we only collected $2.28 for this. So if we sold the call for $2.20 and it reached a price of $32.50, that's a $30 or $3,000 loss per contract. So this example just goes to show that when you're short a call option and the stock price gaps higher, which can surely happen when you're trading individual equities, that's really not going to be a good situation for you as a short call trader, because you have unlimited loss potential on the upside. Alright, in this last example, we're going to look at a at-the-money short call position. And we're going to look at what happens when the stock price remains relatively flat after the trader sells an at-the-money call. So here's the setup. The initial stock price is $105.13, and we're going to sell the 105 call expiring in 31 days. Now we're going to collect a $3.40 premium for selling this call, which brings our break-even price to $108.40. So the short call strike price of $105 plus the $3.40 credit received comes out to $108.40. Now the maximum profit we can make is $3.40 times 100, which is $340. And as always, the maximum loss potential is unlimited. So let's go ahead and look at this example as the stock price is changing. Alright, so as always, in the top part of the graph, we're looking at the changes in the stock price relative to the short call strike price, the break-even price, and any intrinsic value the call might have. In the bottom part of the graph, we're looking at the changes in the options price, so the price of the 105 call that we are short. So as we can see here, the stock price started right around $105, and right off the bat it rallied pretty much to our break-even price of 108.40. Now when that happened, the options price increased from $3.40 to $5.25, so we initially did have a loss on this position because the stock price was increasing at a pretty rapid rate. Now fortunately, the stock price actually did sell off and did kind of just remain right around that short called strike price of 105 through expiration. Now as we can see on the bottom part of the graph, the options price was decaying steadily because, as we know, an option's extrinsic value decreases as time passes and as it gets closer and closer to expiration. So this example just shows that if you sell an at-the-money call option and the stock price remains right around your short strike, that call options price is going to decrease steadily over time because that option needs to lose all of its extrinsic value by expiration. So in this case, the stock price did expire below the strike price of 105, and that means that this option expired worthless. So since we sold it for $3.40, if it were held to expiration, it would have been a profit of $340 per contract. Alright, so let's go ahead and recap the summary of main concepts from this video. So selling call options is a strategy used by traders who have a bearish outlook on a particular stock. Now, selling calls has limited profit potential and unlimited loss potential in theory, but a high probability of profit because of it. Now, a trader who sells a call option benefits from decreases in the stock price or implied volatility, and also the decay of the option's extrinsic value as time passes. So there's really a lot going for a short call strategy. Now, a short call trader can take profits or losses before expiration by simply purchasing the call back at its current price. So if you sell a call for $5 and it drops to $4, you can buy it back for $4 and lock in that $1 profit. Now, on the other hand, if you sell it for $5 and it appreciates to $10, you can buy back the short call for $10 and lock in that $5 loss. So you never have to hold any option position to expiration. There's always a way out. Now lastly, if a trader holds an in-the-money short call through expiration, the trader will be assigned negative 100 shares of stock per call contract, which essentially means you're going to short 100 shares of stock per call contract, and you'll be selling those shares at the strike price of the call that you sold.